Hello guys, welcome to Business Charts. This is second part of Clean Science and Technology Fundamental Analysis. This analysis is about last 5-year financials, ratio analysis, analyst forecast, valuation and investors. Let's start from financials. Sales were increased to 2.8 times from 241 crore to 685 crore in last 5 years, and year-on-year growth numbers also increased at double digit except 2020. Overall sales are consistently increased in every year, and CAGR is 29.8% in the last 5 years, which is very good. The net profit increased to 4.6 times from 49 crore to 228 crore in last 5 years. So the net profit is ahead of sales growth. And year-on-year growth numbers are very good. In 3 years it is more than 40% and very consistent upward trend. CAGR is 46.9%, it is fantastic growth. The raw material expenses was 44% of sales in 2018. Then due to decline in the key raw material phenol price, the expenses reduced to 27% in 2021. But the steep increase in phenol price, the expenses increased to 36% in 2022. So they spent around 30 to 40% for raw materials. Employee cost is around 5 to 7% only. Other operating expenses around 14 to 18% of sales. So overall 50 to 60% they spent as operating expenses. And the other income is contributing 10% of operating profit in last 2 years. It is marginal only, so core operation is generating more money for this company. Because higher other income is not good for any business. In the balance sheet, liability side, shareholders' equity and reserves are more than 80% and there is also no debt. And asset side, cash and short-term investment which is around 29%, so they have enough liquidity assets. So overall very healthy balance sheet. And the operating cash flows decreased last year due to steep increase in working capital changes. Other than that, cash flow was increased from 45 crore to 193 crore. And the capital expenditure and free cash flow is growing every year, but last year capex is higher than operating cash flow, so free cash flow is negative 13 crore. In the ratio section we can understand company's performance and financial strength. Starting from the profitability ratio, the operating profit margin was increased from 30% to 44% in 5 years. It is more than 40% in last 3 years. The net profit margin is increased from 20% to 38% in 2021, and then due to higher raw material cost, margin declined last year. So from these two profit margins we can understand this company enjoys higher profits due to its moat, because whenever a company with more than 40% gross profit margin, definitely there is a competitive advantage. Return on capital employed is more than 39% in recent years, and return on equity is more than 30%. Both are very good. Then the leverage, that is a long-term financial sustainability. Here interest coverage is more than 500 times. So very healthy position with no leverage. And liquidity is short-term financial strength. Current ratio is 4 times and quick ratio is 3 times in last year. More than 1 is very good. And in the last 5 years the company has more than 2 times for every year. So very healthy cash position to manage current liabilities. Inventory days was improved from 4.7 days to 3.2 days. So company takes lesser days now to convert its inventory to cash. Cash conversion cycle all negative numbers. That means company collects cash from customers first and then pay to suppliers after a while. So they have surplus money. More in negative side, more the better. So efficiency of the company is very good in terms of inventory management, cash collection and cash payable. And book value growing at double digit rate for every year, and working capital is positive, so company can easily fund to its operation without raising debt and without diluting shares. So short term financial health is very good. As the business is in growth stage, retaining more money for expansion and future growth. Dividend payout ratio was around 10% in previous year, and I believe the same will be around this level in next few years. And the capex spending in terms of percentage of sales is less than 20% only, so seems it is a capital light business model. And free cash flow percentage of sales is growing and it is more than 10% except last year. So seems it is a cash generating business model. Motilal Oswal last month released a report for this company. There they have forecasted the sales expected to grow at 41% for the current financial year and 32% for the next financial year. And net profit expected to grow at 43% for the current financial year, 36% for the next financial year. So very good double-digit forecast for both sales and net profit. Valuation is important section of this analysis. Here we will calculate the intrinsic value of business using earnings. The assumptions initial value is considered as 17.8, which is past 3-year average EPS value. Consider 16% growth for next 10 years in conservative approach and 18% growth in moderate method and 20% in aggressive method. So last 3 years growth rate is 33%, but I don't like to take more than 20% since we are predicting for next 10 years. And the terminal value, consider the company will be sold at 15 times the earnings at the end of 10th year. Discount rate is 12%, risk-free return 8% plus premium 4%. From the assumptions, the intrinsic value of conservative approach is 620 rupees per share. For moderate approach, 713 per share. For aggressive method, 821 per share. I always prefer to take the conservative approach because our assumptions towards future might go wrong. And at the time of making this analysis, the market value is 1756. It is overvalued by 2.8 times. So it is not right time for value investing mindset investors. However, those who are investing systematically, they can add if they are comfortable with the quality of business. As per reverse DCF model, the growth rate should be 30.9% for next 10 years to justify the current market price. So my view, the growth rate is very high. And discounted cash flow models using free cash flow method is given in our detailed fundamental analysis report. The download link in the description. This is promoter owned business, so promoter holding is 78.5%, FIA holding is 4.4%, DA holding is 4.5% and other investors holds 12.6%. Last year only the company became public, so promoters reduced some ownership during the IPO process and now it is at 78.5% till the last quarter. However, as per SEBI mandate, promoter cannot hold more than 75% in the publicly listed company. So at least 3.5% ownership will be diluted in next 2 years by promoters. And FIA reduced quite a bit from 5.2% to 4.4% in last quarter. But DA increased 4% to 4.5% in the last quarter. That's all my analysis about Clean Science. Please post your thoughts in the comment section below and hit like if the analysis is helpful to you. We'll see you in another analysis. Thank you. Bye bye.